Okay. Now we have chapter 6, which talks about IS 8. All right. Now in our IS 8, what is IS 8, anyone?
Um, Accounting policy, changes in accounting policy,
Mm,
changes in estimate and errors.
Mm-mm, mm-mm.
Okay, the meaning.
No, I'm not saying the meaning. What is in the IS?
Accounting policies,
Is
Uh-huh.
changing
this
accounting estimates, and correction of
errors,
errors.
correction of
Uh-huh. So I heard change in accounting policy, but it's not change in accounting policy. It is accounting policy itself.
okay, okay. Thank you.
Yeah. So accounting policy, right? So for accounting policies, we have IS states, which is here to enhance accounting policies. And why do we have accounting policies? Right? Accounting policy is to enhance comparability of financial statements. Right? So when you compare your policy, if you have a singular policy and you are not changing it, that means you can compare what you did this year to what you did in the previous year or previous years. Right? So that's it. Now, when you can compare your financial statement over time, over a period of time, and also you can compare your financial statement with another financial statement, right? So that's it. Are we there, please? So
Yes,
now
sir.
this accounting policy provides guidance on how we select an accounting policy to use. Okay. Then it discloses changes in accounting policies, right? It gives it gives a guidance on how we account for and disclose our changes in any policy, in any accounting policy, changes in our estimates, changes in prior period error. All right. So that's it. Now, these policies that we have, right? Accounting policy itself are specific principles, accounting bases, accounting conventions, rules and practices that are applied by an entity in preparing the financial statement, preparing and presenting financial statement, right? So that's it. Now, these accounting policies we have, they are different principles and policies, rules and guidelines that we have. And they are there to produce relevant and reliable information. That's the essence of the policy in the first place, right? So we have a policy so that we can rely on on the information provided. Is someone raising his or her hands? Please go ahead, sir. I heard the sound. Is anyone raising a hand? Or shall we proceed? Shall we proceed? Okay, nobody
We
is raising.
can, sir. We can proceed, sir.
Okay. So these policies, right? They are to ensure that we have relevant and reliable information. And of course, where the policies are immaterial, you can disregard them. Where the policy does not change anything, right? You can disregard them. And that's it. Now, so when we're talking of materiality, materiality has to do with the substance, right? And information that if you omit it, it will definitely affect your financial statement. It will misstate your financial statement, right? So whether you omit it or you misstate it or you obscure it, that is when you hide it. Anything you do will have an influence on the decision that will be made with your financial statement. It will have a very huge impact on your financial statement. So when we're talking of materiality, we are looking at the nature of the transaction. There are some transactions, regardless of the size, regardless of the size, those transactions must be stated, no matter how small they are. And the example of such a transaction is related party transaction, right? So that's it. Related party transaction, no matter the size, you have to report it. Now, the magnitude of the transaction also is important. And also, we judge it by the two things, that is, the combination of both nature and the magnitude of the transaction. So that's it. Now, how do we select accounting policies? Right? Now, if IFRS talks about the accounting policy, if IFRS talks about an issue, then you just apply the policy. If there is a standard that covers a particular issue, just apply the standard. All right? That's it. But if IFRS does not cover the issue, then management can make decisions to select the policies that are relevant. Right? Policies that are relevant. And also the policy that are reliable. Then also we reflect on the economic substance over the legal form, which is substance over form. Then also we look at the neutrality of that transaction, right? The prudence and completeness of the transaction. So that's what we have here. Now, any policy you are selecting, any decision you are making, your judgment should be based on IFRS similar issue, how IFRS treated a similar or related issue, right? So if IFRS has treated such an issue before, you look at it. Then also, you look at the conceptual framework, right? Conceptual framework, definitions, and criteria, right? That's it. Then also, optionally, you look at other global standards that will not conflict IFRS. Other standards that will not have a conflict with IFRS, that does not go against IFRS. So that's it. Now, we have the consistency of policies. So, when you have an accounting policy, when you are using any accounting policy, ensure you are consistent with the policy. You can't use a policy this year and another year use a different policy. No. For comparability purpose, for consistency, right? You have to use the same accounting policy. Then the same accounting policy must be used within the same period and from one period to another. All right. Now, the exception is that if IFRS permits a different treatment, right? If IFRS permits a different treatment, then you can apply that different treatment. Are we together?
Yes, sir.
Huh? Are you there?
Yes,
Yes,
sir.
sir.
Yes,
Yes,
sir.
sir.
Okay. Now, we have changes in accounting policies. And these changes are permitted, just like you said, only if it is required, or if there is a new IFRS, or the IFRS has been amended and you are required to follow it. It is permitted. You can change your accounting policy if there is a new standard or the existing standard has been amended. right? So that's it. Also, it is permitted if voluntarily made for more and reliable information, because if there is an information, if there is a standard that will affect your financial statement, that is, if you use that standard, it will affect your financial statement, right? Such a standard, you are not expected to use it. Do you understand? You are not expected to use such a standard if it will have an adverse effect on your financial statement. All right, that's it. Now, there are some things that are not considered a change in accounting policy. For instance, if a new policy is applied to a new transaction you don't have before, you have a new policy and you applied in that new policy to a new transaction. For instance, you don't have any lease in your account before. All right. Now, this year we have an amendment in lease account. Now, where we have an amendment, you don't have any lease before. Now you want to apply the new lease. If you want to apply the new lease standard to the new account, then it is not a change in policy. All right, it is not a change in policy. So that's it. Now, let me look for another thing. We have something called retrospective application. See, all of these things, I believe you have heard it before. But when we say we want to go into calculation, that's when some people will say, we should explain the theoretical aspects. Okay, we are explaining, Sha. Now, retrospective application is that you apply a standard as if you've been using that standard from the beginning, from before, and not just newly. All right, that's it. Now, retrospective application has a requirement. When you want to apply a transaction retrospectively, right, you need to restate a comparative figure and opening balance. All right, you restate a comparative figure and an opening balance. All right, so that's it. Now, also, you present a third statement of financial position. That is the start of the earliest comparative period. Now, let me explain this. When you have comparative figure, when you have a retrospective treatment, you want to apply it. Now, let's say, as at last year, I was using a cash basis. I was using cash basis. Now, this year, I want to switch to accrual basis. Now, the financial statement of last year, I had prepared it on cash basis. Right? Now, that statement I had prepared on cash basis. This year, I want to go into accrual basis. That last year's statement, I need to prepare it again using accrual basis. Now, the one I will prepare again using the accrual basis will not form my opening statement of account, opening statement of financial position. Right? Opening statement of financial position. So that's it. Now, limitations on retrospective application. Now, the limitation is that you can't use a retrospective application when it is impracticable. Okay? Now, when it is impracticable, you can't use it. And that's it. Now, this impracticability that we said, is that when you can't apply it, so for instance, now when the effect of changes cannot be determined, now even when there is a change, you can't determine that change. All right, so that's it. Now, also, when it requires assumptions about past management intention, past management intent, you just want to assume past management intention, guy, just leave it and apply it prospectively. Then also, if it requires a significant estimate that cannot be objectively verified, right? You can't objectively verify it. And that's it. Now, where this retrospective application is not possible, apply it prospectively. All right. So how do we do for prospective application? You apply the new policy from the current date forward. Apply the new policy from the current date forward, and you use it when full retrospective application is impracticable and only partial adjustments are possible. When you can only make partial adjustments, and that's what we have here. Any question from anyone? Any question? No question, right?
No question. No question.
Okay. I thought I'm the only one here. Okay. Now, we have disclosure requirements when a policy changes, right? The disclosure requirements will now be for you to show us how the policy affects current account, prior account, or future periods. All right. So that's it. Then also, you need to show when a policy changes, how it would affect, how it would have affected the account, the financial statement, even though it is impracticable. Right? So even when it is impracticable, you still need to disclose that. All right? You still need to disclose it, even if it is impracticable. So that's it. Now, we have some disclosures. We have some disclosures that we are meant to make, right? The title of IFRS, you have to say it, right? You have to disclose the title of the IFRS. The one that is due to IFRS, the one that is voluntary, you need to tell us, right? The nature of the change, the description of transitional provisions. Now, when new policy is more reliable or relevant, it means you don't need to show it if it is due to IFRS, right? But if it is voluntary, you can show it. That's it. And we have the rest of them like that. Now we move into accounting estimates and errors. Accounting estimates and errors. Now, accounting estimates are required when an item cannot be measured precisely, right? When you can't measure an account, or when you can't measure an item precisely, that's it. Then also, when there is uncertainty, you use an estimate. And when the estimate is based on management judgment, right, you also use an estimate. Now, the next thing we have here is the difference between accounting policies and accounting estimates. They are two different things. right? Now, accounting policies, by definition, they are general rules and principles, right? While accounting estimates are adjustments that are based on uncertainty. Accounting policies are principles. Estimates are adjustments based on assumption or judgment or uncertainty. Then also, the example of it for accounting policy could be your depreciation policy, right? Now, your estimate will now be whether to use a straight line method or reducing balance, right? So that's it. Now, we have change in measurement basis. So you consider a change in measurement, right? Under accounting policy. You consider the changes in the accounting policy, right? Are we there?
Yes. Please, can
we
you
are.
explain more? Maybe with an example.
You said what?
I don't understand that one.
When you consider a change, right?
Yes.
Okay. Now let's take, for instance, your depreciation policy in the company, right? Now, estimate is whether you want to use straight line method or reducing balance method, right? Estimate is whether it is a straight line method or reducing balance method. Now, the policy will now be your policy of, are you using 20%, 30%, or 40%, or 15%, 10%? That's your accounting policy, right? Now, when there is a change in policy, when there is a change in accounting policy now, it has to be included in the company's policy. If you want to change your depreciation policy, your depreciation ratio, right? You have to include it in the accounting policy. In the accounting policy of the company, right? Now, that one has to be in the company's account, like company's policy. But for depreciation, you can decide that when you buy a new asset, you can use any depreciation method for it, whether straight line method or reducing balance. You can choose anyone you want to use, right? And that's it. I hope we can proceed. I hope we can proceed.
Yes, we can.
Yes, sir. Yes, sir.
When there is a change in your policy, it has to be, it's an accounting policy. But usually, we don't measure changes in estimates. We measure changes in policies, not changes in estimates. All right, and that's it. Now, when you have difficulty in distinguishing a policy or an estimate, right, you treat it as a change in estimate, right? You treat it as a change in estimate, which is your IS 8 rule. So that's it. Now, for example, you can choose to depreciate in any accounting policy. Your choice of depreciation is an accounting policy, but the depreciation method is an estimate, right? Aha. So that's it. Now, the changes in the estimate, when we have changes in estimates, that one means you are adjusting the results from new information or developing or a new development that affects the carrying amount. A change in accounting estimates. When you adjust a result as because of new information you've gotten, right? So when you got a new information, you want to change your results, and that's it. Or because of a new development that will affect the carrying amount you have, then in that case, you can have a change. You can have a change in what? Accounting estimate. And that's it. Now, a change in accounting estimate is not a correction of error. It is not. Now, causes of change in estimate is when you have new information, right? Or when the circumstances change. So that's when you have a change in estimate. Now, how to account for a change in accounting estimate? Since it is an estimate, there is no retrospective treatment. All right? The treatment is prospective. Apply it from the current year immediately. All right? Apply it prospectively. That's what we have there. Now, if the changes affect the current period only, then in P&L account, include it in P&L account of that current period only. If it affects current period only, right? Now, if it affects both current period and future, then treat it in the P&L account for both current and future. Are we there? Treat it for both current and future. And that's it. Now, if the change affects assets or liability values, if the change you have affects your asset and liability value, now what you have to do is that adjust the carrying amount from the current period and treat prospectively. You're not treating it retrospectively. Adjust only the carrying amount and treat it on. That's it. Now, for your disclosures, when you are disclosing your accounting changes in estimates, when you are disclosing changes in estimates, all right, you need to disclose the nature and amount of that change. And also, if the future period will be affected, or if the effect on the future period is impracticable to estimate, then you need to state it. If you don't know what the impact will be on your future, then you need to state it. And that's it. I hope we can proceed. I hope we can proceed.
Yes, you can.
Okay. Now we go into errors. Now we have prior error. Prior error is an error that will occur in prior or previous financial statements. And in the financial statement of the prior of the previous years or the previous year. Now, this error is an omission or a misstatement from past financial statements. Omission or a misstatement from past financial statements. So that's it. Now, it can be a mathematical error, arithmetic error, arithmetic accuracy, right? Plus and minus. It can be wrong application of accounting policies. All right. It can also be an oversight or misinterpretation of facts. And also, it can be intentional, which is fraud. That's it. So, please, that person can mute. Please, that person can help us. And mute. Together, please.
Yes, well.
That person should please mute. So that's it. Now, that's what we have on errors, prior errors. Now, prior error relates to periods before the current one, Abby. And the correction of prior error is that all material errors must be corrected retrospectively. If it is a material error, you go back and correct the error retrospectively. All right. Then what you have to do is that you restate the comparative figures, which I've explained the restatement, and then adjust the opening balances, the opening balance of assets, liabilities, and equity, however it will affect you. So you need to restate it. All right. And that's it. Now, in that correction, do not include the correction in the P&L account of the current year. Right? So don't include it in the current year. And that's it. Now, limitation of retrospective treatment. So not all items can be treated retrospectively. Right? So what item can you treat retrospectively? Now, the first is that you have to skip retrospective statement if it is impracticable. Right? You can't do retrospective if it is not practicable. And then prior specific effects cannot be calculated. That is how it will affect the current year. You can't calculate it. How it will affect cumulatively, the cumulative effect, you cannot determine it. In that case, please don't treat retrospectively. And that's it. Now, so what you have to do is to apply the correction prospectively from the earliest practicable date. From the earliest practicable date. And that's what we have there. Now, disclosure requirements. So you are expected to disclose the nature of the error, the amount you have corrected for each line item, right? If it has any effect on EPS, earning per share, the amount of correction at the beginning of the year, if restatement is impracticable, you need to tell us as well and explain why it is impracticable and what you have done in the stead. That is, instead of treating it, since it is impracticable, what did you do? So that's it. We can proceed, right? Am I right?
Yes, sir.
Yes, we
Yes,
can,
sir.
sir.
Okay, so that's it. Now, impact of differences in accounting estimates. The impact of differences. Now, the impact of difference on your fair presentation and IFRS compliance. All right. Now, when you have a change in accounting policies, How will it enhance fair presentation and then comply with IFRS? Right? That is, financial statement must be presented fairly. The income statement, financial position, cash flow statement must be in line with IFRS. And it implies faithful representation of accounting policies. Right? Aha. So you represent your transactions, use the proper definition, recognition criteria, disclosure requirements, and also your presentation. All of this must be stated. Right? Now, IS 8 governs accounting policies, change in estimates and errors. Right? Now, auditors must independently verify fair presentation. And if this is not achieved, a qualified audit opinion will be issued. All right? Yes. So when your accounting policy does not show a fair presentation, your financial statement will be qualified. You know what it means to qualify a financial statement, right? Maybe we know. I mean, we don't know. Is anyone there?
We don't know, sir. Please explain.
You don't know what a qualified audit opinion is?
Yes, sir.
Ah. Please, do we have anyone who knows what a qualified audit opinion? A qualified report? Eh? What is a qualified report? Anyone? A qualified report is when you say that the financial statement does not show a true and fair view of the financial statement. The true and fair view of the financial state of the company. You are saying the account is not properly prepared, does not follow accounting principle, or does not show a true and fair view of the financial statement. That is a qualified opinion. It can be as little as except for, right? It can be as little as that. So that's it. Now, I hope we understand what a qualified opinion is now.
Yes, sir. Thank you.
Okay. Now, causes of the differences in financial statements. What can cause a difference in the financial statement? Now, fair presentation allows you for a range of acceptable outcomes. Right? Yeah, that's fair presentation. It allows you for different outcomes. You can choose the outcome. All right, and that's it. Then also, I've forgotten something. Okay. Also, you can use alternative accounting policies. Right? When you use alternative accounting policies, yes. And judgments, all this can cause a difference in your financial statement. It can cause differences in your financial statement. And that's it. Now, we have revaluation of assets. All right. Now, revaluation of assets improves gearing, but can also reduce your return on capital employed and also earnings per share. Are we together, please? Are we there?
Yes, we are. Yes, sir.
We are there, sir.
Yes, sir.
Okay. Now, when we have a variation, it can arise naturally, right? And it can be used to manipulate financial outcomes. That's it. It can be used to manipulate financial outcomes, and then it now affects comparability. Now, we have the mechanisms to reduce the problem of these differences. All right. Now, the mechanism is now that you choose fewer policy options, right? Fewer policy options. You choose fewer policy accounting options. That's it. Now, the policies that now exist, you compare them to the past, right? Those policies, compare them to the one you've been using in the past, and then you can make your decision. Then also, IS 8 provides rules for selecting policies, which we've done. And of course, IS 1 talks about disclosure of significant accounting policies. All right, that's it. Now, we have IFRS 13 that offers improved guidance on fair value, right? Now, it provides guidance on improved what? Improved guidance on fair value. And that's it. Now, this guidance that we have, all right, sometimes the IFRS 13 does not guarantee comparability. That new guidance sometimes does not guarantee comparability. Okay? But we are saying is that they enhance transparency and understanding. All right? They enhance transparency and understanding. So that's what we have there. Now, where we have IFRS 13, or where we have a new policy that can replace the existing one and then show transparency and understanding, just like I said at the beginning, right? Any policy that will affect your financial statement, any policy that will prevent comparability, you need to avoid that policy. All right? Yeah, you need to avoid such a policy. So that's it. Now, we have creative accounting and earnings management. I thought we talked about creative accounting last week. Did we talk about creative accounting?
No, sir.
Okay. Now, but we must have heard of creative accounting before now. Have we heard of it
Yes,
before?
sir.
So what is
Yes, sir.
creative?
Yes, sir.
Yes, sir.
Those of you who offer CSMA, what is creative accounting? What is creative accounting?
Yeah, creative accounting is the use of aggressive, questionable accounting techniques to produce desired accounting results. It could be by way of window dressing or profit smoothing, or also changes in accounting policies and estimates. Another one is maybe capitalizing expenses that do not meet the criteria of an asset. And
Thank
this is
you.
little I know about.
Thank you, sir. You've done judgment, please. Please give me 1 minute, please. One minute, please. Yeah, sorry guys. Are we there? Are we there, please?
Yes.
Yes, sir. Yes, sir.
Okay. So yes, thank you for that definition. Aggressive methods, right? Now, creative accounting is a legal accounting practice that adhere to simulations, adhere to regulations, but deviate from the spirit of standards to achieve desired results, right? So that's it. Now, these standards, they leave standard that is meant to be used, right? Standard that is required, they'll deviate from those standards just to falsify, just to get whatever results they want to get, to achieve their aim, right? And that's it. Now, most times it is not illegal. Do you understand? Most times it is not illegal, but can lead to a fraudulent reporting. All right. Yeah, it can lead to fraudulent reporting. Now, some of the things they do, just like what he said, they can window dress. All right. Whereby sales made before the year end is reversed, right? So that you can inflate the profits and liquidity. So that's it. Then, of course, they can have off balance sheet financing, right? Yeah, off balance sheet financing, whereby you keep liabilities and assets hidden. Yes, some standards allow you to keep some assets and liabilities. You will not disclose them. All right, that's it. Then also, we have changing policies and estimates, right? Yes, changes in policies and estimates when you shift to the valuation model or depreciation changes, right? So when you do all of those things, yes, you can do it, right? It will not disclose the exact the financial statement, the true picture of the financial statement, and it will still be permitted. Then also, when you capitalize expenses, are we there?
Sir. Yes, sir. We are here.
Yes,
Okay,
sir.
and I hope you understand what you are saying. So
Yes, sir.
the when you capitalize expenses, right? When you capitalize expenses in order to increase your assets, right? Or when you smooth your profits by using artificial balances to even it out across years. And also when you use aggressive revenue recognition. So that's it. Now, the next thing we have to look at here is earnings management. Now, earnings management is also under creative accounting, right? And it means that when you manipulate your earnings using the time and the method changes, right? When you use changes in time and changes in method, okay? So that's it. That is earnings management. When you manage your earnings, when to record your earnings, okay? You determine the time at which you record your sales, your revenue, and the method of recognition. So that's it. Right? Now, the techniques they use is that they can defer or accelerate expenses or revenue. Now, what they do is that if I want my revenue to to be more this year. I want my profits to be more this year. Right? I want more profit. What I'll do is that if I have any expense, I'll push it to, let's say, 2025 account. I want 2025 account to be more. So if I have expenses that came up on the, let's say, 27th, 28th of December, I'll push it to 2026. So that those expenses will not reduce my profit. All right, that's it. And if I have a revenue sales that will come on the 1st of January, I can move it back. I can move it backward and make it show, like, present it as if the transaction took place on the 31st of December. Do you understand? So that is earnings management. Then I can recognize artificial balance. Balance that is not available. I'll just say, there's this one that they use. Oh, what's it called? Some people use suspense account. But the thing is that suspense account has to even out. Has to be even out. It's not a balance account. Suspense account is a zero account. All right. So suspense account is a zero account. So that's why some of the, but of course, some people will still use it to even out the transaction. And that's it. Now, at extremes, this can become criminal because you are simply falsifying your financial statement. That's it. That's what you are doing. You're falsifying your financial statement. So that's it. Now, we have commercial pressures that influences ethics. Right? So your ethical situation. Now, it can be as a result of pressure. All right? It can be as a result of pressure. Now, what are these pressure? Pressure can be from stock price expectation. You are expecting your stock, the price of your stock to increase. But now it has reduced. Okay? Then also it can be performance linked based. That is, your performance, your result will determine your bonus. And because of that, you are doing everything to make your account look like you made more money. All right? So that's it. Now, it can also be a job security whereby you want to meet loan covenants and you want to reduce tax. So those are the things you can have. All right? Yeah, those are the things. Then those are the pressures. Then this can compromise the integrity of financial statements. All right? So when you force it so much, it can compromise the need of your financial statement. So that's it. Now, it can also lead to revenue and asset recognition abuse. Right? You can abuse how you recognize your revenue and assets. All right? And that's it. Now, what else do we have? Example of this revenue and assets recognition abuse is when you use window dressing. All right? Now, window dressing is when you book a sale late in the year and you reverse it to next year. All right? And that's it. Now, some practices reduce profit intentionally. All right? Yeah. There's some organizations that they reduce their profit intentionally. Okay? Now, the essence of this is that, yeah.
God, Rosie.
Is that person talking to us? Hello? Okay, I thought that person was talking to us. Now, some of the practices is that you want to increase your profit in the future. Now, because you want to increase your profit in the future, you reduce the profits now. All right? You reduce the profits now so that your future, you will have more profits in the future. Are we together, please?
We are, sir.
So that's it. Now, one of the things they do when they want to reduce their profit intentionally is to write off assets now and then use them later with no future expense. An asset that has to be in the balance sheet, you are putting it in your income statement and then reducing your profit now. Now, when you are not using the asset in the future, it will not count anything at all. There is no depreciation. There is nothing that is reducing your profits in that future. And also they can create a liability or a provision now and reverse it later. Okay. So that's it. Now, we also have big bath accounting. You can do different names, huh? Big bath accounting. Now, big bath accounting means that you write down everything bad in a poor performing year to make the future years appear better. So now, this poor performing year, you did bad this year, right? Now, because you did bad, you now wrote out all the bad things so that you can make sure that your future appears better. Don't worry, we have a future prospect. We have a good future. The future is bright. Right? Mr. Bright. So that's what we have there. Now, this big bad accounting involves asset impairment and excessive provision. All right, asset impairment and excessive provision. So that's it. Now, now another thing we have to look at here is that IFRS has always limited this behavior of writing down everything bad in a poor performing period. Right? Yes. IFRS has reduced it. Are we together, please?
Yes, we are.
Okay. So that's what we have. Now, we have IS 37 on provisions abuse. IS 37 on provisions abuse. Now,
Excuse me, sir.
yes, sir.
Please, you just mentioned that IFRS has reduced excuse me, they have reduced the did bad, system. Which particular IFRS is it? Which particular IFRS, sir?
Okay. So when we're talking of the IFRS that talks about hold on. Please let me get water, please. I'm coming 1 second, please. Sorry, please. Can someone hear me, please?
Yes, sir. Sorry, sir.
Yeah, thank you.
That is
So now, when we're talking of the IFRS, it talks about the big bad accounting. Now, all the existing IFRS have cleared it. Now, for instance, in IAS 1, IAS 1 talks about preparation and presentation of financial statements, right? So it talks about those items you cannot hide, items that must be disclosed, right? That is one of it. Now, the current IFRS we are treating, which is IAS 8. God help me. IAS 8, right? That talks about accounting policies and estimates, errors, changes in estimates and errors. God. Now, that one is talking about that whether it is an estimate you want to use or it is a change in policy, your estimate has to be objective and unbiased, right? Now, if there is a new information, your changes in estimates must reflect that new information. All right. Now, and also one of these big bags, like one of these big bags that we have, right, is on asset impairment and writing everything bad. Okay, this period is bad. This one is gone. This one is wrong. Now, when you over provide for a particular period, it could be provision for bad debt, and you provide excessively just because you want to make this period bad, and then give us a prospect that you have a brighter future. That is it. All right. So that's one is what we are saying, that all these IFRS that we have, they've treated it. Right now, on contingent liability provisions, I think IS 37, this one I want to do as well. That one also talks about what the criteria of recognizing provisions so that your excessive provision can be curbed, right? So that's it. Now, all these IFRS we have, or IAS, they are there to ensure that your big bath is reduced. All right, regardless of when the period occurs, regardless of when the transaction occurs. Now, because you want to have a poor performing period, you're having assets impairment and all of that. Don't forget, we also have another IAS that talks about any event after a reporting period. If anything happens after a reporting period, how you should treat it. Right? If it affects your financial statement, if it doesn't affect, right? So that's all these items that we have mentioned, they have an effect. All right, they have an effect on the financial statement. And that's why we are saying that those are the standards that are treating the big bath. I hope we can proceed now, sir. So I should have mentioned 3 to 4 IAS and IFRS now. Right?
Thank you, sir. Thank you so much, sir.
Welcome, sir. Sorry, I'm having hiccups. Okay, now we have IAS 37 and abusive provisions, excessive provisions. Now, before IAS 37, provisions were used to manipulate profits. Some people will over provide, some people will under provide. Right? Now, provisions were often based on management intent. Provisions is not objective, it is subjective. It is whatever the management wants that we provide for. Right? Now, common uses include provisioning for restructuring warranties and redundancies. right? So those things are just there to determine the management intent, right? To play out what the management intended, right? Now, some of the taxes is that they recognize a large provision during the bad years and then reverses later when they don't need it anymore so that it can boost future profits. All right, that's it. Now, IS 37 now controls restructuring provisions. It now controls or prohibits restructuring provisions until a formal plan is committed. So you can't restructure a provision until there is a plan to it. Are we together, please?
Yes, sir.
So that's it. Now, it also requires remeasurement of provisions at each reporting stage. All right. However, judgment and estimation still provide room for manipulation. Right? Now, your accounting judgment and estimation still provide room for manipulation. All right, and that's it. Now, do you have any question? I think this is the last thing. Okay, that's the last thing. This one is just summary of everything. Do you have any question? Do you have any question, please? Any question from anyone? In the absence of question, we'll continue from here in our next class. Good night, everyone.
Good night,
Thank
sir.
you,
Thank you
sir.
so much.
Thank you,
Okay,
sir.
sir. Thank you.
Thank you so much.
You're welcome.
Thank you, sir.